Well, greetings, my beloved clients and friends. I want to do a video today about inflation. And I'm out here a little bit later than usual because, one, the inflation read was early this morning and I needed to digest it. And two is I went to the doctor yesterday and he said my vitamin D was a little bit low. So, in the best interest of my clients, I'm out here in the sun, getting my vitamin D. You'd be pleased to know he said I was in excellent health. By the way, we hired another advisor. So people sometimes go, well, what happens if something happens to you, Jonathan? And so we keep that in consideration. We have a staff that I've been training and you don't need to worry about that. Anyway, let's get to inflation. And so this morning, the CPI came out and it was a little bit hotter than anticipated. Hotter than anticipated. Inflation was like at 3.5% year over year. And over the month, it was a little bit high. So the stated goal has been to get inflation down to 2%. That's what the Fed's been trying to do. It's been already a couple years now that it popped up to 9%, which was very high. I mean, higher than it had been in decades. And so Powell dramatically raised interest rates to slow things down, and he brought it down from about 9 to about 3. So he got it pretty much under control, but not to all the way to where he wanted to be. You know, that last mile is often always the hardest, and so that's what they're struggling with. And I wanted to talk a little bit about inflation and the expectation, how it affects the markets and investing. And so when interest rates are low, the market likes that because they're able to, when they discount future cash flows, they discount it at a lower rate, meaning they're more valuable today. When interest rates are high, they have to discount at a higher rate, meaning those future cash flows are less valuable today. So higher interest rates tend to bring the markets down. Lower interest rates tend to prop up the market a little bit. And the other thing is, when interest rates are low, people don't like sitting on cash. They like working that cash. And a lot of that ends up going into the market or ends up going into opportunities that grow businesses that help the market, right? So, and when interest rates are high, people often are comfortable sitting on cash because it's earning them a good interest. They're less likely to take to invest, right? If their cash could get 5% with no risk, let's say, some people might be happy with that. And so it slows down the rate of investment. It slows down the flows of money into the markets. So we generally like low interest rates. And we generally not too thrilled about high interest rates. So why has Powell had to raise rates so aggressively? Well, one reason is because they were at zero for about a decade during the financial crisis of 2008. Rates went way down, and then with COVID, rates went down to zero again. So they had to get them off of zero to slow things down. And the other reason was because all this economic and fiscal monetary stimulus that occurred during COVID overheated the economy, and they had to slow it back down, right? So that's why they had to raise rates from about 0 to about 5 in a very short period of time. And it largely got it out of control, but that last mile, they're struggling with a little bit. There was hopes around the beginning of the year that they were done raising rates, and that actually the likelihood would that they could start bringing rates back down even this year. Some on Wall Street were hoping for 6 rate cuts this year, and that was overly optimistic, and then the consensus settled around 3 rate cuts this year. And now even 3 rate cuts is looking less likely. 2, 1, or maybe 0 are on the books because inflation is persistent. And so I want to talk about, like, what is inflation? And the knee-jerk reaction will be, that the prices of stuff goes up. And that's not 100% correct. It's like, we say that the sun rises and the sun sets, but because that's what it looks like from our perspective, but not really. Really, we're revolving around the sun, and we're revolving around our axis, and that's what it makes it look like the sun rises and sets. So really, inflation is the dollar getting weaker. The dollar buys less and less stuff, so it makes stuff look more and more expensive, because with the same dollars, we seem to be able to afford less and less. So it's called inflation. You could say it's price inflation, but it's really dollar devaluation. And so why would the value of the dollar be going down? And 2 basic economic reasons is that the supply of dollars is too high, or the demand for dollars is too low. And both of those are occurring right now. During COVID, they issued a ton of dollars. And when the government spends a lot of money, that's basically pushing dollars out there, right? And Biden has been spending like crazy, right? And there's no slowing down in him. And now he has to win an election, so probably the inclination is to keep spending, right? Because in the short term, people like it when he spends a lot, right? It'd be like if you said, okay, kids, no school today, we're going to Disneyland. And we're gonna get the VIP pass, and we're gonna stay in the Disney hotel, and we're gonna have dinner with Goofy, and whatever you want, you go ahead and have it. Will that dad get votes? Of course he will. But a few months down the road, there's gonna come a bill, right? And so, that's kind of Biden's attitude. He's like, let me get all the votes I can and spend money and make these people happy, get myself reelected. But man, it causes inflation. It's very inflationary when he's pushing out all that money, and Powell's trying to slow it down, and he's pushing forward and pushing forward. So the supply of dollars is very high. That's inflationary. And the demand for dollars is somewhat weak. When you look at the balance sheet of the United States, we're piling on debt. Would you want to invest in an enterprise with that much debt? Would you want to invest in a company with negative cash flow, right? They run a deficit every year. Would you want to lend to such an institution? And a lot of people are thinking, well, maybe not. So they have to entice those lenders with higher and higher rates, right? To prop up the demand for the dollar. There's talk about alternative currencies like Bitcoin, like we are the global reserve currency, but there's some rumblings that there's some desires globally for another reserve currency because of some of the things we've done in wars, like the war with Russia and Ukraine. It wasn't a good look when we just used our influence, just put tariffs and sanctions on Russia, and other countries kind of looked at that and said, wow, and just froze their dollars. And that gives people a thought like, well, or sovereignties like, wow, if they could do that to Russia, they could do it to us. Maybe we want out our head, maybe we shouldn't hold so much in dollars, So there's some things that are hurting the demand for the U.S. dollar geopolitically, and so to increase demand, the Fed has to raise rates. So if they lower rates, they're going to decrease demand further. So maybe they can't be in such a rush to lower rates, and so the economy seems to be doing fine. Unemployment is under 4%, which is a very robust economy, almost to the point where it's a constraint on business, because we don't want there to be 0% unemployment, because what would happen if there was 0% unemployment? That would mean that everybody wanted a job, had a job. So if you're an employer and you're trying to find employees, there's nobody looking for a job at 0% unemployment. So it's hard for companies to grow when the labor markets are super tight. It's hard for companies to operate when the labor markets are super, super tight. So it's nice, 4% unemployment is not bad. When I was in school, they said max full employment was 5%, and it's been under 5 for a long time. So 4% unemployment is not so bad. So there's no really rush for Powell to stimulate the economy that's already, sufficiently stimulated. So I don't really see an urgency to lower rates. And 5%, I mean, it's high from where we've been in the last decade, but the last decade has been historically low. We've never seen the rates as low as they were the last decade. And even people were scratching their heads like, what does 0% interest rates mean? What would be the effects of it? Because no one had ever seen it before. No one had ever studied it. So compared to 5 is high, but compared to history, 5 is right in the middle of normal. So that 5% rate is called the nominal rate, and the nominal rate means the real rate plus inflation. So if inflation is at 3%, really the real rate, or the real cost of money, is about 2%. And that's not very expensive. To be able to borrow money at 2% plus inflation is not inordinately restrictive. Okay, so Powell holding rates at 5%, it's not like he's holding the economy hostage. Compared to what Volcker did, he took rates up to like 14. That is really squeezing the neck of the economy, right? 5 is not a chokehold, really. So, it's about where it should be. If you wanted 2% inflation, which is what Powell wants, and about 2 to 3% GDP growth, which is kind of what we're trying to get to, that would be, you add those two together, that's about a 4 to 5% interest rate. So, that's not that high. Okay, so yeah, Wall Street as like a entitled child wants lower rates, but it's not necessarily urgent or necessary considering where the economy is. So we may get 1 or 2 rate cuts this year, we may not. And when the market was pricing in 3 or more rate cuts, and then reality starts to set in that it's going to be maybe less than 3, maybe 2, maybe 1, maybe 0, then the market has to recalibrate their expectations. So that could create some volatility in the market, maybe a little even some downside in the markets in the short term till the markets digest the likelihood that rates aren't going to be eased as much as they had hoped. Okay, so that's kind of where we are. But that's all stuff in the short term. In the long term, what I see that excites me is we're in this major evolutionary cycle. And if you think about the Industrial Revolution 200 to 300 years ago, and it changed civilization really from an agrarian society to where people worked in factories. So people moved, and there was a mass migration from the farm to the factory, and there was a massive increase in the productivity of labor as machines enhanced workers' productivity, and it was a massive boom to the global economy, right? And those things are deflationary. It brings the cost of stuff down. You know, with one of the examples in The Wealth of Nations by Adam Smith, written in 1775, he was talking about pins, and the way they used to make pins. You know, I don't remember the exact numbers, but a worker could make about 50 of them in a day, let's say. And now with machines, you can make about 50,000 of them in a day, or 5,000 of them in a day, right? One laborer can make that many pins. So imagine what would that do to the price of pins? Bring it way down. So those type of major evolutions in labor productivity are deflationary. So that gives us some hope on the horizon. That stuff doesn't happen overnight, but long term it's deflationary. Now, so we went from the farm to the factory, and then we started moving to the office, and especially in the US, right? We kind of started exporting our factory jobs to lower cost labor places around the world, and we started having more office work. I remember when I was in high school, we had wood shop and metal shop and auto shop and stuff, because not everyone was going to go to college, and some people needed, you know, factory work type of stuff. Well, they kind of got rid of that, and they made everyone think that, well, you have to go to college and end up working in an office, and there was all these office that came to be more common, right? You had things like the Rust Belt, what happened in, you know, coal country. Those places kind of got wiped out in favor of areas where, you know, people live in the suburbs and drive into the office, right? And that was the way for probably 50 years, increasingly. So we went from farm to factory to office. And then, you know, what's the talk now that, you know, people are working from home and they're not going back to the office in droves, and there's a oversupply of office because we're going through another major shift. The technology has enabled a different type of economy and a different type of career path. You know, you don't just go work on your father's farm, or you just don't go work in the factory, or you just don't go work at a big Fortune 500 company in their office. There's a new economy called like a creator economy. And so there's a new modality, and AI and technology are really spurring this. So we have to look at this at the what's right in front of us. You know, today's CPI print and inflation and unemployment and interest rates and things like that. But we also have to look out at what's ahead of us more than a few months or years out when we're doing our investing. And this is what we're seeing. We're seeing this incredible opportunity and an incredible new paradigm developing because of AI, because of technology. And we're seeing this move from, like I said, this progression of humanity from the farm to the factory to the office to the interface, and we're not sure what that interface is, whether it's a smartphone in your hand, because there are a lot of creators work from their smartphone or from a computer, or maybe it's going to be glasses, or what that interface is, but it's a more direct interface where they don't have to be in an office. And I think that's the next iteration, and there's some companies that are benefiting from that. You think about companies like Airbnb and Uber. I mean, they employ, and they don't really employ, they enable is a better word than employ, enable people to work from their car or rent out their room. Companies like man, the name slips me, but they help you make a website to sell stuff. You know, companies like Amazon employs people, but they also enable a lot of people to sell stuff on Amazon, to sell stuff on Facebook and OfferUp and all these other things that people do that's not traditional work. And it has the previous generation scratching their head. They're like, why don't you just go to college, go get a good job at a big Fortune 5 company, you know, like I did at DuPont or Nabisco or you know, one of those big, huge companies, and have benefits and a pension and stuff like that. That was the office worker generation. There's a new economy on the way, and there's companies that are enabling it. Whether it's Apple by putting a powerful computer in your hand, or Google and putting unlimited information and access to advertising at your fingertips, and companies like that anybody could put a payment system on their website and start selling stuff. And these content creators and these influencers and all those things, what are the picks and shovels of that economy? And those are some companies that are really doing well, and that are positioning themselves for this new phase of human productivity. And all this is also going to be massively increase in productivity, and over time I think it will help with inflation. But we can't lose sight on that, what's happening right now, as a perspective of what's happening globally, and navigate, you know, with those like they say in geography, 2 points determine a line. You know, that's our, when we're taking a shot, we look at it at the rear sight the rear sight, and then the front sight, and then the target, and to try to take good shots in our investment portfolio. So hopefully that gives you some perspective on what we're trying to do, trying to stay out of falling in the river. But hope you guys have a great day, and we'll keep at it at the helm.